Hi, I'm Ann Gaviola. Welcome to the Peak on Global, where we break down what is trending in the business world and what you need to know to stay ahead of the curve. Joining me now is Brett Chang from the Peak podcast. Welcome, Brett.
Hey, Ann, great to be with you.
Let's talk about summer travel. Now, anecdotally, this is the thing that people around me are talking about. Do you go international? Do you stay in Canada? I do want to talk about prices with you, but first, let's get into delays, because air travel has become a real headache. At least that's been my experience, especially during peak travel times, and that is what summer is. Now, the country's busiest airport, Pearson International, saw about 40% of its flights leave delayed. This is March numbers. That's higher than the 30% delays that it was clocking in back in 2019. And New York's JFK had about 30% delays for comparison, while Chicago O'Hare between around 21%. What are your thoughts on this, Brett?
Well, if you recall last summer, there were two primary issues that were affecting travel. It was one, the delays in processing passengers in security and at customs. Now that, by and large, seems to have been resolved. If you travel today, usually you don't have those crazy 2-3 hour customs lines
Thank
you have
goodness.
to wait for to get into the country. I know it's a huge improvement. So that's been solved, which is great. But the bigger and probably more systemic problem of just a shortage of staff, of aircraft, that remains. And that is mostly because we went from 100% of travel to 0% of travel during that COVID period. And now to get back into that 70, 80, 90% of where we were pre-COVID is very challenging. And so airlines are now working to ramp back up.
Yeah, some airline analysts tell me 2019 was kind of the golden age of air travel, and we're a ways away from that. Now, it's worth noting, Brett, that Air Canada's on-time travel rate was 57.3%, meaning 42% of flights left late. That jives with my personal experience. Now, on the topic of prices, a spike in demand has driven prices higher. People have probably already noticed this. There are signs that this may be the new normal, at least during peak travel times. What are your thoughts here, Brett?
Well, I think that's exactly right. It's the new normal until it's not. And so right now we're looking at like that's going to be the case, at least for the next year or so. I hope that at a certain point we will return back to where we were in 2019, that there'll be enough capacity in terms of planes in the air, that there'll be enough staff from pilots to flight attendants to the people who are checking you in, that all gets corrected back to 2019. But it takes a while for that to happen. And for prices in particular, one interesting anecdote I heard was that we accumulated a lot of those frequent flyer miles while COVID was happening. We weren't really traveling. We were still spending. And so now people have just tons of miles and points that they can spend on flights, which means that it's actually really hard to get those flights booked. There's limited availability if you have points. So all of these factors are cumulative, and they're all causing, one, higher prices than we're used to seeing, and two, those delays that we just talked about.
Yeah, and I should ask you, Brett, do you have summer travel planned? Because experts are suggesting that if you can afford to wait it out until at least September, you may be ahead of the game on price and as well on the annoyance factor.
Well, I've got a trip to Tulum planned in May for a friend's bachelor party, so that'll be nice, but not much else planned for the summer for exactly that reason. It's just it's very expensive right now.
Yeah, I'm going to try and hold off on international travel as well, at least until the fall. And September's really nice. You still get a lot of that really kind of warm, beautiful weather. Okay, second topic. Here's a headline that I didn't see coming. So TD Bank has become, TD Bank, of course, people will know it as one of Canada's biggest. It has become the most shorted bank stock in the world. It boils down, Brett, to its exposure to risk in the Canadian real estate market, exposure to the U.S. banking system. I believe it has a, let's call it 10% stake in Charles Schwab, which is described as America's largest discount brokerage. And TD has plans to acquire a U.S. regional bank, First Horizon, and a lot of shareholders and analysts think it's overpaying for that one. Your thoughts, Brett?
Well, short sellers have a thesis, and that thesis isn't necessarily shared by other analysts, and that's certainly what's going on here. They've made a bet that the stock of TD is going to go down. Now, it doesn't necessarily have to go to zero for them to make money. It simply has to go down. So you can believe that the share price is going to go down because they're too exposed to U.S. regional banks, and they think that they're overpaying for some assets and that the Canadian housing market might sink a bit. It's interesting because every bank in Canada has their own kind of expertise. If you look at Scotiabank, they have a huge Latin American and Caribbean presence. TD just happens to have a huge U.S. exposure. And so while the stock price may go down, I don't think we should be concerned that TD Bank is going to suddenly collapse in a Lehman Brothers type moment. Canadian banks are some of the most stable, most regulated in the world. And if you look at TD Bank's balance sheet, it's still pretty responsible relative to many other financial institutions in the world that we're looking at, when we talk about places like Credit Suisse in particular. So I don't think we should be too concerned about it. The stock goes up and down, and that's true for any company. And I really wouldn't worry about TD Bank going to zero. I think that's extremely unlikely.
Yeah, though we could see it stumble and fumble a little bit. You answered this. The number one question that I get asked about is, do we need to worry about TD? And people are really nervous. The second most asked question I get is, what about our other big banks? Are they in trouble, in danger too? And as you mentioned, every analyst, market watcher that I've connected with tells me they're not too concerned about it. It's well capitalized, it's diversified, it is a big, big bank, and it has sound risk management systems in place, and it's closely watched by Canadian regulators. It is important to note that, the hedge funds betting that the stock price is going to go down, they can be wrong. They've been wrong before. I think this is more of a reflection of jitters about the entire financial system at this point. Kind of feels like, is anyone really safe?
Yeah, look, there's lots of economic risk. Let's be certain about that. And we don't really know where the shoe is going to drop that could trigger the next economic crisis. That's one of the unknown unknowns that we have to kind of deal with as investors and as business people. However, we only have one frame of reference. The most recent financial crisis was in 2008 and 2009, which was primarily driven by financial institutions and insolvency due to their overexposure to certain real estate markets in the U.S. and the subprime mortgage market. So, that's what we know happened last time, but that doesn't necessarily mean that that's going to happen this time. It could. There could also be insolvency issues with banks. We saw that with Silicon Valley Bank, but that in itself was not the trigger for a broader economic crisis. But there's lots of other issues going on right now that might actually be much more important and much more timely. And so I think it's important to have a broader perspective where not just because the last economic crisis was triggered by a bank doesn't mean that it's going to happen again in that exact same way.
Yeah, I mean, history repeats itself until it doesn't quite. Let's get to this last topic. It is related, and we'll get to why. You and I have been talking about the tech rout or the tech right sizing, whatever you want to call it, with all those headline stories of mega layoffs at the tech giants. These are the companies that are also bearing the brunt of high interest rates, in addition to the financial sector. But some wonder if these tech giants are making a comeback because of the promise of AI. And you saw that reflected in sentiment towards names like Meta and Microsoft. What's your take on what's happening here, Brett?
There's a lot of excitement around AI. If you ask kind of tech watchers and VCs, they'll tell you that they believe that this latest wave of AI is the next platform shift. So if you look back over the past, let's say 20 years, the big platform shifts have been mobile, which was the most recent one. Before that was the internet. Some people thought it might be crypto, but that seems to be fading out. They think AI is the much more likely platform shift. And so what's happening is that investors and companies are now pouring millions, billions of dollars into the development of this new technology, hoping that it will be that platform shift that creates a significant value. However, the applications of that, we're seeing a taste of it, but we don't really know what that's going to look like in the next few years, and everyone's trying to race towards finding that as fast as they can.
Yeah, there's this kind of global arms race when it comes to AI. I just hope regulators are paying close attention, because whatever they think is happening now is probably, let's call it 1 to 2 years outdated, my personal take. Thank you so much for your time and your insight, Brett.
Thanks, Ann.
And you can get all your daily business news with the Peak Daily podcast. It is available for free on Apple Podcasts, Spotify, and wherever you find your favorite podcasts.